Hello, I am John, and you are watching OG John AG Extra. If you currently hold more than 100 ounces of silver in any form, physical bars, coins, ETF shares, futures contracts, mining stocks, allocated storage, or any combination, this video is made specifically for you, not for casual observers, not for someone thinking about buying their first ounce. This is for you, the investor sitting on a position that, based on Friday's closing price of $84.40 per ounce, represents a minimum value of $8,440 and could potentially be worth hundreds of thousands or even millions depending on the size of your stack. What's about to unfold in the silver market this week, beginning tomorrow, Monday, February 24th, 2026, will impact holders of 100 ounces or more in fundamentally different ways compared to someone keeping 10 ounces in a drawer. The decisions you must make before tomorrow's market open are unique. The risks you're exposed to are distinct. The opportunities within your reach are different, and the potential mistakes that could cost you real money are not the same as those facing smaller holders. Take a seat, close your other browser tabs, and focus completely for the next 20 minutes. What I'm about to explain could represent the most critical information you'll receive regarding your silver holdings this entire year. John AG Alert, Sunday, February 22nd, 2026. Let me be absolutely clear about the rules that govern this channel, rules that are permanent and non-negotiable. I sell nothing. I will never sell anything. No courses, no private groups, no trading signals, no mentorship programs, no investment funds, absolutely nothing. If anyone reaches out to you claiming to represent this channel and requests money, they are criminals. Report them immediately to the platform. This content represents educational analysis based on publicly available information. This is not financial advice. I am not a licensed financial advisor. I have no knowledge of your personal financial situation, your risk tolerance, or your investment objectives. Every investment decision you make is entirely your responsibility. Always protect your capital first. Verify every single data point I mention through original primary sources. No exceptions to this rule. Now let me explain precisely why 100 ounces represents the threshold where everything fundamentally changes. At today's prices, 100 ounces of silver equals approximately $8,440 in total value. This is the minimum quantity where your silver position transforms from being a small speculative bet into a substantial financial holding that requires active, deliberate management. When you hold less than 100 ounces, you're essentially maintaining a hedge, a modest insurance position, perhaps even just an interesting conversation topic. The absolute dollar value simply isn't large enough to generate meaningful financial consequences, whether positive or negative, in your overall financial picture. Once you cross above 100 ounces, however, your position becomes materially significant. A 10% price movement in silver, something that has occurred multiple times within single trading sessions throughout 2026, represents $844 or more in direct portfolio impact per 100 ounces held. The 31% intraday swing we witnessed on January 30th translates to more than $2,600 per 100 ounces. For someone holding 500 ounces, that single day's volatility on January 30th represented a $13,000 swing in position value. These aren't hypothetical scenarios I'm projecting. These movements actually occurred just 4 weeks ago in a single session. And here's what matters most. The underlying conditions that generated that extreme volatility haven't dissipated or improved. They've actually intensified. We've seen 4 margin requirement increases. Vault inventory depletion continues accelerating. Chinese export restrictions have now entered day 53 with no resolution. Shanghai premiums over COMEX prices keep widening. The ratio of paper claims to physical metal stands at historic extremes. Every single amplifier of volatility that existed in January remains active today, and several factors have deteriorated further. If your holdings exceed 100 ounces, you need to systematically address 5 critical areas before Monday's opening bell. Each area presents different considerations depending on exactly how you hold your silver, and making an error in any single one of these areas under current market conditions could cost you a substantial portion of your position's value, or in worst-case scenarios, the position itself. The first critical area, know your exact holding structure and understand its specific vulnerabilities. This might sound elementary, but it's not. The vast majority of silver holders who interact with this channel through comments cannot accurately describe the precise risk profile associated with their specific method of holding silver. They know they own silver. What they don't know is what they actually own in structural terms, or the exact mechanisms through which that holding could be compromised or impaired. If you physically possess your silver, coins, bars, rounds stored in a home safe or secure private location, your vulnerability profile is the most narrow and contained. You face zero counterparty risk. No custodian has the ability to lend out your metal. No exchange can force a margin call on you. No ETF sponsor can impose cash settlement on your position. No brokerage can auto-liquidate your holdings at 6:15 p.m. on a Sunday evening. Your risks are confined to physical theft, damage to the metal itself, and the opportunity cost of holding an asset that generates no income or yield. In the current market environment, this represents the lowest risk holding structure available. However, this structure comes with a significant limitation that becomes critically important once you reach 100 ounces or more: liquidity. Selling 100 or more ounces of physical silver quickly at a fair market price is not as straightforward as clicking a button on a trading app. Your local precious metals dealers may not have sufficient cash reserves on hand to purchase large quantities at spot price. Online dealers typically require shipping arrangements, insurance, authentication processes, and settlement periods that can span several days. During a sharp price spike, the premium you might receive above spot price could be substantial and advantageous. During a price crash, however, you may face discounts below spot price because dealers protect their own positions by widening their bid-ask spreads during periods of high volatility. You need to know your exit channels before you need to use them in a crisis. Identify at least 3 dealers, preferably 2 local and 1 online, who have the capacity to handle transactions of 100 ounces or larger. Verify what their current buy prices are relative to spot. Understand their payment processing timelines and methods. Complete this research today, not during a market emergency when your judgment may be compromised by stress. If you hold shares of SLV, you're holding paper silver that's custodied by J.P. Morgan, priced according to COMEX paper market benchmarks, and governed by trust prospectus provisions that include potential cash settlement clauses under what they term extraordinary circumstances. At 100 ounces equivalent, which equals approximately $8,440 worth of SLV at current share prices, your position offers high liquidity, can be traded during any regular market session, and presents essentially zero counterparty risk during what we'd consider normal market conditions. But the conditions we're experiencing right now are anything but normal. SLV experienced approximately $3 billion in redemptions during January 2026 alone. Roughly 29 million ounces have exited the trust year to date. The trust currently holds approximately 560 million ounces, which represents somewhere between 62% and 70% of all identifiable silver in Western vault systems. The custodian, J.P. Morgan, simultaneously functions as the largest deliverer of COMEX silver contracts and maintains one of the most concentrated short positions in silver futures. These structural conflicts of interest don't typically matter during calm, normal market conditions. During physical delivery crises, however, they become enormously significant. Your specific risk as an SLV holder with 100 or more ounces equivalent is that a divergence event between paper and physical markets could cause SLV's share price to track the paper price downward, even while actual physical silver prices remain elevated or continue rising. You would see losses appearing on your screen, while the actual metal theoretically backing your shares is gaining value in the physical market. This divergence has already begun manifesting. Shanghai physical silver is trading at $94 to $95, while COMEX paper is at $84.40. SLV tracks COMEX pricing, not Shanghai physical pricing. If this divergence accelerates further, SLV shareholders experience losses while physical holders see gains. This asymmetry is critical to understand. If you hold PSLV instead, your silver is fully allocated at the Royal Canadian Mint, with published serial numbers and independent third-party verification protocols. Your counterparty risk is with Sprott and the Canadian government's mint facility, rather than with a bullion bank that has a documented history of market manipulation. However, PSLV shares frequently trade at premiums to their net asset value, and these premiums can contract sharply during periods of selling pressure. If you purchase shares at a 4% premium and that premium collapses to zero during a volatility event, you lose 4% of your position value instantly, completely independent of whatever silver's actual price is doing. At 100 ounces equivalent, that premium compression represents approximately $340 in immediate realized loss. If you're holding futures contracts, you occupy the most vulnerable position category in the current environment. Each standard COMEX silver contract represents 5,000 ounces. At $84.40 per ounce, that's $422,000 in notional value per single contract. With maintenance margin currently at $23,000 following the most recent hike, you're controlling $422,000 worth of silver with just $23,000 in posted capital. That represents approximately 18-to-1 leverage. A mere 5.5% adverse price movement completely wipes out your entire margin deposit. The 31% intraday move on January 30th would have generated $130,000 in mark-to-market losses per contract. If you're holding futures contracts representing 100 or more ounces equivalent, which is just a small fraction of a single full contract, you absolutely must understand that your leverage profile places you at extreme risk, given the volatility conditions currently prevailing in this market. If your exposure is through mining stocks, you're exposed to silver price movements, plus additional layers of operational risk, management execution risk, jurisdictional and political risk, cost inflation risk, and general equity market risk. Mining stocks typically amplify silver's price movements by a factor of 2 to 3 times. A 5% move in silver prices might translate to a 10% or 15% movement in mining stock prices. At a portfolio value equivalent to 100 ounces, a 15% swing represents approximately $1,266 in gains or losses, which is manageable. At larger allocation levels, however, this leverage amplification becomes materially significant. You need to know exactly which companies you hold, what their all-in sustaining costs are, their debt levels and leverage ratios, their jurisdictional exposure and political risk factors, and critically, their hedging policies. A mining company that has hedged 50% of its production at $60 silver will dramatically underperform an unhedged producer during a silver price spike. That performance difference matters substantially for your portfolio returns. The second critical area: calculate your actual cost basis and understand your real profit or loss position. This matters far more than most investors realize because your cost basis determines 3 crucial factors: your tax liability when you eventually sell, your genuine risk tolerance during drawdowns, and your psychological anchor point during volatile market conditions. If you purchased 100 ounces at $25 per ounce and silver is currently at $84.40, you're sitting on approximately $5,140 in unrealized gains. Your position is deeply profitable, which gives you substantial cushion to withstand volatility. If you bought 100 ounces at $75 per ounce, you have $940 in unrealized gains on a $7,500 investment. That's a 12.5% return. But a 12.5% pullback from current levels completely erases your entire profit. Your risk tolerance for drawdown is necessarily very low because a single bad trading day could take you back to break-even or into loss territory. If you purchased 100 ounces at 110 or during January's spike to those levels, you're currently underwater by approximately $2,560. Your psychological state is fundamentally different from either of the previous 2 scenarios. You're likely anchored to your original purchase price, hoping for recovery back to break-even, and you're particularly vulnerable to panic selling during any further drawdowns because each additional dollar down increases your loss. You need to develop a plan more urgently than anyone else watching this video. Take the time right now to write down your cost basis for every single silver position you hold. Calculate your unrealized gain or loss for each position separately. Understand precisely where your break-even point is. Understand exactly how much of a drawdown you can absorb before your unrealized gain transforms into an unrealized loss. At holdings of 100 ounces or above, this isn't optional work. This is the fundamental foundation underlying every decision you'll need to make this week and beyond. The third critical area: understand the specific risks and opportunities that exist during this particular week. We're approaching March delivery on COMEX. March represents a major delivery month for silver contracts. First Notice Day is approaching rapidly. The time period between now and First Notice Day is when the interaction between paper contract positioning and actual physical delivery demand reaches maximum intensity and stress. Current open interest for March contracts represents approximately 340 million ounces in paper claims against just 98 million ounces in registered deliverable inventory. That 3.4 to 1 ratio on March contracts alone, not even counting obligations from other contract months, creates mechanical price risk in both directions. If the amount of contracts standing for physical delivery exceeds market expectations, price could spike violently upward as the market is forced to reprice silver higher to incentivize holders to release physical metal into the delivery system. That represents the bullish scenario. Alternatively, if contract rolling accelerates and actual delivery demand proves manageable, the paper system survives another monthly cycle and price could retreat as the delivery crisis narrative loses its near-term urgency. That's the bearish scenario. Both outcomes are legitimate possibilities with reasonable probability. Your plan must account for both potential paths. At holdings of 100 ounces or more, you need a written plan addressing each scenario explicitly. I covered strategic planning in a previous video, but it's worth repeating specifically in the context of this particular week. Get a piece of paper right now. Write down two distinct scenarios. Scenario A. Silver spikes above $90 during March delivery pressure. What exactly will you do? Will you take partial profits, hold everything, add to your position? At what specific price point do you execute each of these actions? Write down the exact numbers. Scenario B, silver drops below $80 as delivery concerns ease and margin hike pressure continues. What will you do? Buy the dip? Hold your current position? Set protective stops? At what specific price level? Write it down with precision. Having both plans documented in writing before the market opens removes the emotional component from decision-making during the actual event. You'll execute according to your rational plan rather than your emotional state. Sunday night's Globex opening at 6 p.m. Eastern Time represents the first real test. Over the past 14 months, silver has opened below Friday's settlement price 64% of the time on Sunday night openings. The average decline during the first 30 minutes when this pattern triggers ranges from 0.8% to 1.2%. At the current level of 84.40, that translates to a potential drop to 83 cent or 83.40 barn before full market liquidity returns Monday morning. If you're holding 100 ounces in futures or leveraged positions, that $1 to 140 decline represents $500 to $700 in mark-to-market losses within just 30 minutes of the market opening. Can your margin absorb that drawdown? Have you already calculated the answer to this question? If not, answer it right now before Sunday evening. The fourth critical area, assess your insurance coverage. At 100 ounces of physical silver, you're holding approximately $8,140 worth of portable, easily concealable, universally recognized value in your physical possession. If that metal is stored at your home, is it properly insured? Standard homeowners insurance policies typically provide coverage for precious metals only up to $200 to $500 in total, unless you've specifically added a rider or scheduled personal property endorsement. If you're storing 500 ounces at home, you're holding $42,200 in value, with likely only $200 to $500 in actual insurance coverage. That represents a 98% gap between your actual holdings and your coverage protection. Contact your insurance provider first thing Monday morning. Ask specifically about the coverage limits for precious metals. Inquire about scheduled personal property endorsements specifically designed for bullion. Ask what documentation requirements they have for filing a claim in the event of loss. Insurance companies typically require purchase receipts, photographs of the metal, serial numbers for bars, and independent appraisals for large holdings. If you don't currently have this documentation organized, begin organizing it today. Photograph every bar with serial numbers clearly visible in the image. Photograph every tube of coins with mint marks visible. Store these photographs in a secure cloud storage location that's separate from your physical storage location. Keep all purchase receipts organized chronologically by date and amount. If you're holding silver in a private vault or commercial depository, verify the insurance provisions in your storage agreement. Most reputable depositories carry insurance covering the full declared value of stored metals, but you need to verify the specific coverage amount, identify the actual insurer, understand the deductible amount, and know the claims process procedures. If the depository's insurance coverage includes a per-client limit and your holdings exceed that cap, you're effectively self-insured for any amount above that limit. This isn't exciting content. It doesn't involve Shanghai premiums or COMEX delivery drama. But at holdings of 100 ounces and above, the mundane administrative work of proper insurance coverage and documentation protects your position against risks that are statistically far more likely to cause you actual losses than any single dramatic market event. Theft, fire, natural disasters. These risks are real, ongoing, and most importantly, they're insurable. Market volatility is exciting and captures attention, but it's temporary. A house fire that destroys 500 uninsured ounces of silver is a permanent, unrecoverable loss. The fifth and final critical area, decide your strategy for the next 30 days and commit to it in writing. The next 30 days will likely represent the most volatile period in silver's modern trading history. We're entering March delivery, Chinese export controls are entering their third month with absolutely no historical precedent for how or when they might reverse. COMEX registered silver inventory is potentially falling below 90 million ounces. Shanghai premiums could widen beyond the $12 to $15 range. There's a realistic possibility of a fifth margin hike from CME. We have multiple macro data releases coming, including Federal Reserve commentary, CPI updates, and employment reports. Geopolitical developments continue evolving, including U.S.-Iran tensions. Every single one of these factors creates potential for explosive price movements in either direction. At holdings of 100 ounces or more, you need a specific 30-day strategy, not a vague general intention. You need a written strategy that explicitly addresses the following questions. What percentage of my total silver position am I willing to sell within the next 30 days under any circumstance? If your answer is 0%, write that down and commit to it. If your answer is 25% at $95 or higher, write down that specific price and the exact quantity you'll sell. If your answer is 50% if silver drops below $75, write that down with the specific trigger price. What additional capital am I willing and able to deploy to add to my position during the next 30 days? If silver drops to $75, would you buy more? How much more? With what specific capital? From what source? If silver spikes to $100, would you take partial profits on existing holdings with the intention to redeploy at lower prices later? At what specific re-entry price would you buy back in? What is your absolute maximum pain threshold? This is the price level at which you would exit your entire position, regardless of your long-term thesis and conviction. Every position needs this number defined in advance, even if your floor is $20. Even if you sincerely believe silver is ultimately going to $200, you need an absolute floor price below which you acknowledge either your thesis was incorrect or the market's capacity to remain irrational has exceeded your ability to remain solvent. Write that number down right now. If silver ever reaches that level, execute your exit without hesitation or second guessing. The purpose of defining an absolute floor isn't to predict where silver is going. The purpose is to protect you from catastrophic total loss in the event of a scenario you didn't anticipate or consider. What is your target price for this position over the next 12 months? What outcome would make you consider this investment genuinely successful? Is it $100 silver? $120? $150? Having a clearly defined target helps you evaluate whether intermediate volatility represents meaningful signal or just short-term noise. If your 12-month target is $120 and silver drops from $84 to $75 this week, that represents a 60% upside opportunity remaining from the temporary dip, not a reason to panic and sell. The context provided by your own written target prevents emotional reactions to short-term price movements. Write all of this down today before 6 p.m. Put the paper in a drawer that you can access quickly when needed. When the market inevitably moves this week, and it will move significantly, pull out that paper before you touch your brokerage app or make any decisions. Read your own words that were written by your rational, calm self during stable conditions when you weren't under pressure. Then act according to that plan, not according to whatever fear or greed you're feeling in that stressed moment. Every single data point I've referenced in this video is publicly available and verifiable. COMEX Vault data is available through the CME website. CFTC positioning data is published in Weekly Commitment of Traders reports. SLV holdings and the complete trust prospectus are available through iShares. PSLV bar lists and net asset value are published by Sprott. Shanghai premium data is available through the Shanghai Gold Exchange. CME margin requirement schedules are published through official exchange advisories. Insurance policy terms are available through your specific insurance provider. Everything is verifiable, everything is accessible, and you should verify it independently. If you own more than 100 ounces of silver, you own a meaningful material position in one of the most volatile, structurally distorted, and potentially explosive commodity markets in the world right now. A position of that significance deserves more than casual, passive attention. It deserves the same level of strategic planning, systematic risk management, appropriate insurance coverage, precise cost basis awareness, and structural understanding that you would apply to any other investment of $8,000 or more in your portfolio. The people who will profit most from the next 30 days won't necessarily be the ones with the strongest conviction or the most bullish outlook. They'll be the ones with the most thorough preparation. Conviction without preparation is just hoping and wishing. Preparation without conviction is just hedging and playing defense. Both elements together represent how substantial positions get successfully managed through volatile market conditions without being destroyed by them. You have until 6 p.m. tonight. 5 critical areas to address. written plans for multiple scenarios, independently verified data, clear understanding of your cost basis, proper insurance coverage, complete knowledge of your holding structure and its vulnerabilities. The checklist is straightforward and simple. Actually executing it before the market opens is what separates holders who survive extreme volatility from holders who become its casualties. Verify everything independently. Plan before you trade. Protect what you already own. I'll see you in the next one.